Well, it is a pleasure to be with you today, and I'm delighted that it has been possible for this event to take place, albeit virtually. As you know, the Capital Markets Union project is the EU's plan to create a truly single market for capital across the EU. It aims to get investment and savings flowing across all member states, benefiting citizens, investors, and companies, regardless of where they are located. A well-functioning and integrated capital market should allow the EU economy to recover in a sustainable manner after the pandemic, and an economically stronger Europe, thanks to better functioning markets, should serve its citizens and help the EU play a stronger role on the global stage. It should bring benefits already being enjoyed in the larger established financial centers to people, to companies in the smaller member states. Businesses, including small and medium-sized ones, should be able to access funding, and investors should be able to invest in projects across the EU. And market participants should benefit from more competitive and transparent markets. Building on the progress already achieved since the launch of CMU in 2015, the European Commission made a proposal for a covered bonds directive in order to promote the EU market for covered bonds as a source of long-term finance, and in order to ensure greater certainty for investors when dealing in cross-border transactions of certain securities and claims. This would help integrate EU capital markets further by facilitating cross-border operations and increasing legal certainty for investors. We think that when looking at the respective advantages of bank financing and market financing, we should not oppose them. They can mutually reinforce themselves in the single market. And in the case of covered bonds, their placement with investors allows banks to extend more loans to households and companies collateralized by real estate. The main purpose of the Covered Bonds Directive is to develop a new framework applicable across all national markets in the EU. The Covered Bonds Directive follows the minimum harmonization principle, the aim of which is to provide a common definition of a covered bond as an instrument recognized across the EU, and to also harmonize minimum quality standards applicable to these covered bonds. The Commission's vision on the EU-wide legal framework for covered bonds aimed to enhance them as a stable and cost-effective source of funding for banks, especially where markets within the EU are less developed. The new directive set out the main structural features that a covered bond needs to respect. The amendments to the Capital Requirements Regulation strengthen the conditions for granting preferential capital treatment for financial institutions investing in covered bonds. The new legal framework will open the potential for developing covered bonds markets in member states that did not have such markets until now, or where more could be done. There are still some member states in the EU that have legislation in place, but no covered bonds issuance so far. And other member states had no legislation at all and were probably waiting for some kind of an EU benchmark before taking that path. The EU legislator also needed to look at ways to make EU covered bonds even more attractive to EU investors and third country investors. This is particularly important in two respects. First, it is at the heart of the CMU rationale to support banks in providing more financing to the real economy and create new opportunities for investors to have access to a broader range of plain vanilla investment products. Second, covered bonds are right now benefiting from ECB purchase programs. However, one day these will be scaled down, and at that point it will be precious to have in place a framework which ensures that investors can invest in a simpler and standardized manner in these products. A well-established, well-recognized EU covered bonds label based on a robust regulatory framework will help in this regard. Another objective of the new legal framework was achieving prudential soundness. The new rules will further strengthen prudence and provide additional comfort to investors. The new regime also achieves simplification, providing clarity about rules and supervision. Both investors and issuers benefit from the simplified legal environment. The introduced EU label will help investors with due diligence, while issuers should find it easier to build collateral pools to structure covered bonds issuances and to sell cross-border. The Commission is committed to assist member states during the transposition process. The implementation of the Covered Bonds Directive will involve intensive discussions with member states on any topic of interest in the member states, and the Commission will provide technical assistance to the member states in order to ensure a timely, smooth, and comprehensive transposition in the member states. Apart from this, the Commission is empowered by the directive to take further important steps. The Commission should submit a report to the Parliament and the Council, together with a legislative proposal, if appropriate, on whether, and if so how, an equivalence regime could be introduced for third country credit institutions issuing covered bonds and for investors in those covered bonds. The Commission should also submit a report to the Parliament and the Council on the risks and benefits deriving from covered bonds with extendable maturity structures. The deadlines for both reports is July 2024. By July 2025, the Commission is requested to submit another report to the legislator on the implementation of the Covered Bonds Directive with respect to the level of investor protection and the developments regarding issuances of covered bonds in the EU. And that report should include recommendations for further action. Two future steps ahead that the Commission should take seem to attract particular attention from stakeholders. The first step concerns the problem of potentially overlapping liquidity requirements in the context of the liquidity buffer introduced by the Covered Bonds Directive. The Commission intends to amend the delegated regulation on the liquidity coverage requirement. The main purpose of the amending act being to address the interaction between the liquidity buffer requirements in the Covered Bonds Directive and in the delegated regulation. The second step concerns the so-called European secured notes. ECNs. ECNs could provide a useful additional source of funding, in particular for financial institutions that do not have access to the securitization markets and or have difficulty issuing unsecured long-term debt. ECNs could increase the variety of funding tools available to banks, which in turn could unlock more financing for SMEs and infrastructure projects, thus contributing to economic growth in the EU. In particular, ECNs could play an important role in providing new funding to SMEs, thereby enhancing the diversification of funding sources available to them, along with speeding up their transition to a greener and more sustainable economy. By July 2024, the Commission should submit a report on the possibility of introducing a European secured note together with a legislative proposal if appropriate. I'll conclude by noting that in recent months, the covered bond market demonstrated remarkable resilience, which seems to overcome the challenges posed by the COVID-19 pandemic. This confirms that the EU was right in seeking to boost this market further through targeted regulatory changes. I hope your discussions today will confirm this, and I thank you very much for your attention.